You've got 93 billion Aussie dollars in funds under management. When it comes to deploying that pile, does inflation still rate top of mind for you, or do you think these markets have, for better or worse, priced in the risk of even higher than expected inflation for 2022?
No, thank you. It's a pleasure to be here. No, it's been such a fascinating couple of years, actually. But you're right. I think the year of 2021 will be remembered as one where inflation was the theme that everyone was talking about. And, I think we recognised pretty early on, actually about 18 months ago, that inflation was a topic that was going to be coming through, and not necessarily in the sorts of magnitudes that we've seen. But I think we recognised then that the huge amounts of fiscal stimulus that were being unleashed globally, were going to potentially trigger a rise in inflation that investors were not expecting. And at that time, inflation assets in the fixed income market were extremely cheap. And we, use that as a potential opportunity. And we've had that core theme really in our portfolios for about 18 months. It's been a very fruitful strategy, obviously, as inflation is not only a surprise, but break-even markets or inflation markets globally and in Australia have risen extraordinarily over the last 18 months. So it might seem strange now, just when inflation is really taking off as an investor risk, that we've decided to actually call time on that view, and we've decided to move back to a more neutral view on inflation markets.
You talk about the expectation of volatility, the year of volatility, in fact, for 2022, because you don't necessarily see an easy landing out of the policy exit from the pandemic, right? What sort of optionality then do you keep within your arsenal in terms of being able to react very quickly to potentially some nasty surprises?
Yeah, and I think, again, being an active fixed income manager does give us a range of opportunity sets and a range of instruments that we can pull at different times. You're right. I think, we have characterised 2022 as a year of volatility. And as you said, that's largely because we are now moving into a different phase of the cycle where the market is starting to price, the exit of QE policies, the beginning of rate hike cycles. Obviously, some central banks have already started on that path. Historically, even if you look at the last decade, that has proven very challenging for central banks to be able to exit from these extreme policies. We think that with that, it's going to bring more volatility in financial markets as, they start to react to those tightening of conditions. Certainly, we're not particularly worried about the growth picture here globally. If anything, we think the private sector looks, more sound perhaps than it's been for, 10 or 20 years. So it's certainly not a view of fundamentals here. It's just one that, exiting from policy stimulus has proven extremely difficult in the past decade, and we don't expect the next year to be any different.
Yeah, I'd love to ask you, Beverley, how you handled the Fed pivot. If we look at WIRP for Fed funds futures and expectations and so on, we see that fully priced in now are 3 rate hikes next year and possibly even more than that. Talk to us a little bit about what you're telling clients when they say to you things like, but hang on, the break-even hasn't really moved. The 10-year break-even is still below 2.5%. The 5-year forward is a 2.5% swap-based or less than 1.5% Fed fund spread-wise. So what do you tell them?
Yeah, so the reason why we've moved neutral on those break-evens, as you just mentioned, even though, we don't necessarily have a view that inflation itself is going to suddenly fall here, as your previous commentator mentioned, there's still a lot of price pressure coming through the system. And so it's certainly not a view of inflation itself. It's just more a view, as you said, markets are pricing rate hikes over the course of the next couple of years. And what we believe is that even if inflation were to surprise to the upside further, that the reaction in markets would most likely be one where they would accelerate the expected pace of timing. And that therefore there would be a natural cap on those break-even rates.
What are you anticipating? How far ahead can we actually make forecasts these days, Beverley, with Omicron and perhaps more variants down the line?
Great question. And one of the really interesting features that we've noticed, and again, one of the main thesis behind the increase in expected volatility, is what we're starting to observe in forecasts is a broadening dispersion. And that hasn't happened since the GFC. So what I mean by that is the range of potential outcomes is getting wider for things like growth, for inflation particularly. And historically, that wider range or that more uncertain macro picture has fed through to higher financial market volatility. So that's a very interesting development. And again, that's for us. When the range of potential outcomes is so wide, financial markets are going to find that more challenging. And again, as an active manager, being very nimble, I think, is going to be very important in 2022.